So welcome to today's class. So today we are going to cover ABCD pattern. And basically it actually follows the same rules we discussed yesterday. It makes use of the ratios and harmonics, and you're going to see the key ratios which we consider under ABCD pattern, and the harmonics which we incorporate here for it to be complete. So ABCD pattern, rules of engagement. First of all, we say there are key ratios we use, and the primary we use is the 61.8%, the golden ratio. In most of our discussions, I think I've mentioned that 61.8 is one of the key ratios. Anytime I see a rotation there, I take it very serious. Yes, so when I see signal there, I don't let it go. Again, it also gives you a very good risk-reward ratio. We'll see that on either maybe Thursday or Friday's class when you're doing risk management. So the key ratios we use here, one is the primary used is 61.8% retracement, Fibonacci retracement ratio, and then 127.2% and 161.8% Fibonacci extensions, right? Time frames, again, you say the ABCD pattern can be identified on any time frame and can be seen in formation of other advanced patterns. So the tactics for the ABCD pattern are very similar to other well-known advanced patterns. We seek to identify 3 market moves. Yeah, by the market moves, we mean like swings. 3 market moves and 2 major Fibonacci zones. The combination of these moves forms the 4 points ABCD that fulfill the pattern. Okay, so rules of engagement, criteria number 1. And you're saying the ABCD pattern begins with a market movement or impulse leg or a swing that establish our A and B points. That's like a move from high to low. So the high becomes our A and the low becomes our B. That's the swing. Yeah, so that's how we're going to mark all that in the platform to see how we establish that. So that's how we start off, the pattern starts off, a move from point A to point B. We mark A and B. So once the A and B patterns have been identified, we then look for our first criteria. So remember now the AB, it gives us a starting point to draw our Fibonacci from point A to point B. So that it can measure, it can now generate for us the ratios. We see where we're expecting the next leg to be formed. So the market forms, so criteria number 1, the market form the C completion point by fulfilling at least a 61.8% retracement of the AB leg. So once the market has formed, so we are saying the first thing, the market makes that kind of a move. Okay? So we have point A, then here we have point B. All right. So becomes point. So now from there we draw our Fibonacci. Remember, this is if this is the way our swing is, this is a downtrend market. So to draw our Fibonacci, we will place it here. We drag it downwards to point B. So that it generates the ratios like that. Okay. So we are saying the market forms the C completion point by fulfilling at least a 61.8% retracement of the AB. So we draw our A to B, and then we draw a Fibonacci, and then the lines we'll get our 61 somewhere here. The market will retrace. All right. So once we draw a Fibonacci, which now generated for us the ratio, then we know for the C leg to be valid, the market need to retrace up to where our ratio 61.8% is. We demonstrate all this in the platform. So note that the BC move remains valid as long as there is at least a 61.8% retracement of AB, and there is not, and not the word is not, is bolded and highlighted. There is not a candle close beyond the 78.6% retracement of AB. So take note that the C completion point, the control wick or the shadow, can extend beyond the 61.8% retracement of AB as long as the candle does not close beyond the 78.6% retracement of AB. And we have an example here. As you can see, this market is downtrending, all right? So we mark our swing from point A to point B. From there, we draw our Fibonacci retracement. We will pick it, place it here, drag it up to point B. Then it generates the ratios. So now we mark our point AB. The next point is point C. So for ABCD pattern, for it to be complete, C must be at 61.8%. At least the candle has to reach there. The wick can extend way above 61.8, but should close below 78.6% retracement. All right. So now that's how we generate our leg C, A, B, C. All right. So now we are waiting for the market. Once the market comes and it returns at 61.8, now that's a valid point C. Now we are waiting for the market to give us the fourth point, that is point D, to complete the ABCD pattern. So we need to find out, how do we identify where should the point D be for the pattern to be valid? So we have criteria number 2. If criteria number 1 has been met, then we look for criteria number 2. And we've seen in our case here, our criteria number 1, which is where C is supposed to be a 61.8, that criteria has been met, right? So the second criteria, the market forms the D completion point by fulfilling at least a 1-to-1 harmonic move of the point AB leg coming in at 127.2% extension of AB. Remember, we actually did a sample of 1:1 coinciding. It was one of our examples of a point of confluence in our yesterday's class. So we are saying once C is formed, we are looking for point D, and for point D to be to be valid, we expect AB. Sorry, it cannot be carried. I just have to draw another one. Basically, what you do, you draw for it to be complete. You use this to measure for you where point D will be. So you have to click on it and then you carry it. You don't draw two independent lines, or they have to be equidistant. They have to be equal lines. That's why you say 1:1. The previous line is equal to the second line. I'll also demonstrate that to you in the platform. So we are saying for point D to be complete, we expect 1:1 completion. AB is equal to CD, all right? Once we carry this line and place it here, it coincides where the second line CD ends. It's also where we have our extension 127.2%. Then now our D somewhere here becomes valid, all right? So you see the market forms the D completion point by fulfilling at least a 1:1 harmonic move of AB leg coming in at 127.2% extension of AB. So for ratio confluence confirmation, a measurement of the BC may be taken and the extension should come in at around 138.2% to a 161. This may be a little bit complicated, but I will demonstrate to you what that means. Then you say the D point remains valid as long as there is at least a 127.2% extension of AB. There is not a candle close beyond the 161.8 of AB. Not in a valid CD move, there must be at least a 127.2%. Failure to achieve this, it invalidates the pattern. And we have a case of an invalid one. You say we had our first leg A to B. Then criteria 1 was fulfilled. C is at 61.8% retracement. Then we did our 1:1. You carry this line, you bring it here, it tells us D should be here. So it will only, and then we also draw our Fibonacci extension, and it tells us 127 is there. So if the market reverses anywhere before it touches there, then it invalidates the pattern. The pattern is not valid. It will only be valid if the market comes all the way, reaches here. Then now this point, our point D becomes a valid point, right? So how do we trade this kind of a pattern, ABCD pattern? So for an ABCD pattern, once it is valid, once the market validates point D, we are actually looking to enter our entry at D. Like in such kind of a move, if the market came all the way here, then we would sell at this level. Yeah. We will enter a sell at point D once the market fulfills the ABCD pattern rule. So this is how we enter. So you can, once point C is fulfilled, and when you measure your 1:1, it coincides with 127, you can already place your pending order here. Like in this case, we'll set a buy stop. Not buy, no, actually it's a buy limit. It's a buy limit because the market is already here. It has not yet reached here. So you're telling the market, you expect you to turn here. So when you reach here, fill my order, go back with me. All right. So limit order placed at D, completion point 127.2 of AB. Then stop placement, that is the stop loss. You place it at 10 pips plus or minus 161.8% extension of AB. So if long entry, stop goes 10 points, like in this case, be a long entry, we are buying. Stop goes 10 pips below the 161.8% extension of AB. So our stop loss will be somewhere here, 10 pips below this extension of the 161.8% extension of AB, all right? So then our targets are, where will we place our TP? At 38.2% retracement of AD, all right? So now we'll draw another Fibonacci from A to D, all right? So our TP number 1 will be at 38%, 38.2% retracement of AD. Then our target number 2 will be at 61.8% retracement of AD move. So when attained, trail stop to structure. Okay, we discussed about trailing. So that one you are trailing it manually, all right? So we have a case here, a very nicely done if completion of point AD. You can see AB retracement. It went up to slightly above 61, but no candle closed above 78.6. Then the market moved and it reached point D, where 1:1 coincides with 127.2% extension of AB. So once it is reached and your entry is filled, you draw a Fibonacci from A to D so that you know where to place your take profit. Target 1 should be at 38.2% retracement of AD. Target 2 should be at 61.8% retracement of AD, right? So at this point, we are going to look at let's look at our charts. We see at MT4 what it will show us. You can see my screen. it to move to the left, but it's a little bit adamant. Great. So you can see in this case, let me remove everything so that we start off together. Now, as you can see, this is M15 time frame. This market was uptrending, right? You can see we have a swing there. We have another swing there. Another swing there. So we have L1. Then we have our new structure high, okay? Then here we have higher low, okay? Higher low. It is higher than the previous. And see, for an uptrend market, the lows are getting higher, and the highs are getting higher. So then we have the market also. It played us by expectation. Then it gave us new structure high. Here, our expectation was for the market to give us another higher low, okay? Maybe somewhere, let's say we draw that. So you're in the market, you should maybe give us another higher low somewhere here, all right? But the market went further and it actually went past the previous higher low. So it made a lower low, lower than the previous low. So that's already an indicator the market it's reversing. Sorry, why did I pick that? I don't know. So it is like showing the market is actually changing direction because it made a lower low. Instead of reversing somewhere here, a low which is higher than the previous low, it went further. So our expectation failed, all right? And we said when the market, now the low is lower than the previous low, the market starts incorporating the rules of a downtrending market. So now we start looking for opportunities to sell. So we are like, so where do we sell? Okay, so when the market fails, you can see already we had a very strong, when you look at this point here, we had a very strong kangaroo tail here. You can see it. Very strong kangaroo tail where the market reversed, all right? So now we look for opportunity to sell. You draw your Fibonacci, and then you can see already we have some area of support here. It was resistance, so it was resist. We expect now to also remain to be a resistance area. You can see here it faced resistance. So you draw where you expect the market to face resistance, all right? And in our case, it coincides with 61.8. So here would have been a good entry to sell. Actually, I had sold earlier in my live account, but I show you so what made me to enter that entry. So expect the market to go down, so you enter your sell there, right? Because you expect the market to continue moving down and down. And of course, it gave us a very nice new structure low, which is lower than the previous one, okay? So now that the market is moving down, once the market makes a new structure low here, we draw another Fibonacci, okay? There you go. Let me do it at... I'll also first, before I move here, we can use the previous one to see whether the rules of ABCD pattern was fulfilled. So when the market made a new structure low, we draw our Fibonacci, looking for opportunity to sell. The market came, it touched 61.8%. That's fine, all right? So we have our point A there. Then we have our point B. Okay. And the market goes and gives us a point C because it is touched. We say at least it touches 61.8%. So we have a very nice point C there, right? Point C. Criteria number 1 has been fulfilled, all right? So for us to enter a painting entry, a buy limit, we need to see that criteria number 2 is fulfilled. And criteria number 2, it tells us the CD leg should be somewhere where, first of all, AB should be equal to CD. 1:1 harmonic should be fulfilled, all right? So you come and draw your harmonics. A to B, carry the same line because it has to be equal. So this becomes our measuring line for where D should be, all right? And we say D should be, these two should coincide. The 1:1 should coincide with 127. And here they don't coincide. Although we can see actually it has gone a little bit further. There's no coincidence. So our D may not be valid, all right? So we abort that mission for now. We are not looking to take an entry at point D because it's invalidated, all right? Sorry, I took away one of the letters, but I will need to use them again. But we still continue looking for opportunities to sell, all right? So our next move, the market is still moving down, so we draw a Fibonacci, our next swing, all right? Again, the market, now we can go to lower time frames. Sorry, I need first to make my letters available near me so that I can use them. Bring them where I can be able to use them. Okay, so this is M5. So this becomes our A. Hey, what am I doing? Sorry for all this. I didn't know I was carrying a Fibonacci. So now this becomes our C will be here. This becomes our A, and this becomes our B. Okay? Is C valid? As long as no candle closes above 76, it is still valid, all right? But the moment a candle closes above it, then it should not be valid, okay? Then we draw our ratios. This is our measuring stick. We bring it here. And this is a perfect match. You can actually, it's more or less. Let me hope I drew it properly. Let me just be sure. And this can pass. This can pass. Okay, let's say they really coincide together such that this one is at this point, all right? So if they coincide, you can actually set your buy stop here. Not a buy, but in this case, it's a buy limit, all right? So what you're going to see, we are telling the market, because as per my pattern, that is when it is fully fulfilled. There, here it is still hit. You can see they are not really touching each other so much. But let's assume that our D it's valid, and 1:1 coincides with the extension 127.2. So you'll come and the price there it's around 29.20. You open there. We are setting up a painting order, and it's a buy limit. All right, it's a buy limit. So we are saying the market, when the market gets at D, D is at 29.20, enter for me that entry. All right. That's a pending order now at our point D. So when the market comes, you expect it to be filled and it returns up there. It goes up with us, all right? So that's our point D. Although this is not so valid, but you're just doing it for demonstration. Once I see one which fulfills the rules, I will share with you. Sorry for that. That's our point D, all right? Then we set our take profit. First of all, our stop loss. We said stop loss should be 10 pips below 161.8, right? 161.8 is around 29.14 or thereabout. So I'll put a 29 0 something. Our stop loss should be at, let's say 29.005. Okay, 29.05 will be somewhere there. Then our target, we have two targets. When you have like, you set up two targets, when you enter several orders. So we can also enter another order so that we utilize our two targets just for demonstration purposes. So we're saying we'll enter another entry. It's a buy limit, yes, at the same price, 29.20. We place it. Stop loss, the same place, 10 pips below the 10 pips below the extension 161.8. That you said is 29.05. Modify. So where are we going to place our take profit? We say it should be at 38.2% retracement of AD and 61.8 retracement of AD as well. So we are going to draw another Fibonacci. We can actually remove this one just to avoid confusion. For now, we can remove it. Let me ensure nothing else is highlighted there. Otherwise, I'll be forced to repeat many things. All right. So now we'll draw Fibonacci from A to D, where our D is supposed to be. All right. So our TP number one will be at that 8.2% retracement of AD. All right. So our first entry will put a take profit at. I thought the price is what? Sorry. The price there is at 29.29 or 0.3. Take profit 29.29.3. Okay. For the other order, our take profit will be at 61.8% retracement of AD, which is somewhere here, and that is at 29.35. 29.35. Once you set your order, you let it run. All right. You can see, okay, this is a different thing. So you let the market run, it will come, it will fill them. So this being a demo account, I will just let it run. If it picks, fine. If it goes against us, fine. Just to demonstrate to you how we utilize the ABCD pattern. Once if it gets validated. But as we saw, ours is not very a nice ABCD pattern. Let me make it see when I'm using a smaller time frame if it's gonna be. Perfect. Let's hope it plays out. So we leave it running. Once it gets filled, if it's gonna play out. But again, we want to be sure no candle closes above 76.4% because the moment it closes, even criteria number one is invalidated. All right. So we let it run and see what's gonna happen at the end of the day. That will be on Thursday. Great. So that's how I think everything is very clear unless there's a question about ABCD pattern, how you identify it and how you trade ABCD pattern. Remember, if you notice the market early enough, you can benefit in two ways. Like in this case, I've already entered a sell entry at C, okay? But now this one, my take profit should not be, actually I don't even put stop loss should be at 29.45. 29.45. My TP should be at point D, which is 29.20. Was D at 29.20? Something changed. Oh, yeah. Just a second. These two are these ones here. So my TP of 29.20, how comes I cannot see it? This is my stop loss. Oh, I think it's being covered here by this yellow, the green, the by limit order, but it's okay. I've set my TPs. All right. So what I was saying, you can benefit in 2 ways. Once you enter at C, you can still sell there, and then you set up your other pending order. So you benefit by 3 trades at the same time. But if you can also come and find, maybe you come with the market already moved from C, it's somewhere here. So you only wait to trade at point D, right? Once it fulfills the criteria. Any question on ABCD pattern? Before I answer a question which was asked earlier on the WhatsApp group. Any question regarding ABCD pattern? Any clarification required? Let me see. I cannot still see you. I need to. My phone is misbehaving. We are together, but in case of any question, always ask. We will be able to answer you. So if a candlestick goes and closes above this, then it's safer to just close all these trades. You can always remove them, your pending orders. If they are invalid, if you don't need to keep them, you just close them here, right? You don't have to keep them pending if they are, you feel they would not be, feel that they are not really necessary. So the moment a candlestick closes above 76, then it will invalidate our event criteria number 1, all right? Because you say a candle can go past it, but should never close above 76.4. The moment it does that, now the whole pattern is point C is invalidated, so we cannot proceed with the ABCD pattern. But remember, there's what you say there, 1:1, that one will always work. 1:1 does not necessarily have to be an ABCD pattern. It can apply anywhere without having to follow the criteria of ABCD pattern, okay? So that one can always go by itself. We call it 1:1 or AB is equal to CD. AB is equal to CD is different from ABCD pattern. ABCD pattern, it only applies when criteria number 1 and 2 are fulfilled. 1, C it's at 61.8%. 2, D is at 127.2% extension of AB Fibonacci ratio. And also D is at 1:1 harmonics of AB and CD, all right? But AB is equal to CD means just, it's as just the way we put 1:1, expecting the market to make the 1:1 moves. So those are 2 different, but you're going to see all that as we proceed. Great. There's a question which Francis asked earlier, which about the entry entered in gold, XAU-USD. That entry I entered at H1. So when the market made this move and came here, I came and drew my Fibonacci here. It was in my live account, so I can demonstrate. Of course, when I'm training, I use the demo because this data will be available to almost everybody. Yeah? So you can see when the market moved up, you can see I was expecting a little bit of resistance here, right? I was expecting some resistance here, since there was also resistance earlier, okay? When you see to the left, this side, you can see the many candles. There was a lot of struggles. So when I saw the market start reversing, I think I was using a smaller time frame, around 10:15, all right? I just entered my shorts there. I entered my sell, okay? Because it's at 76.4%, and also an area of resistance. So another good, advantages of entering at 76 and 61, we said it gives you a good risk-reward ratio. Remember, we said our stop loss has to be above 100. So when you enter an entry close to 100, it means your stop loss is it's nearer. You have fewer pips for your stop loss as compared to if you entered your entry at 38. All right. So what happens in risk management? If you enter a trade at 76, you can take a bigger volume, right? Because the risk is smaller. But when you enter at 38, you get a smaller, you enter at a smaller volume because the risk is bigger. That's how you manage your risks, okay? So at 76.4, an entry around 76.4, you can take a bigger risk as compared to an entry taken at 38.2, all right? Actually, I rarely take an entry at 38.2. If I have to, I have to do maybe 0.02, a micro lot. Because again, if you enter there and the market moves against you, and then it gives you a signal at 76, you can still add positions, all right? Let's say you took an entry at this level. Here, you took an entry here. You entered here, all right? Then the market started moving against you. It gives you another opportunity to enter. It is still okay to add positions. We call it averaging. Now the market has given you an opportunity to enter at a very good price. So you'll have two trades running at the same time, right? So that is advisable. When you enter at 38, enter smaller volume so that retain more in case the market moves against you. It gives you an opportunity to enter more positions at a good risk reward ratio, right? Because again, our take profit will be, let me just mark them for you to get it clearly. So our stop loss will be whether you enter at 38 or at 76, stop loss has to go above structure or above your 100. And your TP, we say, should be at around 127. That's TP. Okay. So when you look at an entry entered here, the risk is bigger. All right. Look at this distance. When you enter here, this is the risk you're taking. Okay. But when you entered at 76.4%, that's the risk you're taking. You can see the risk is smaller here. All right. So here, because the risk is bigger, you enter with a smaller volume. Right. The TP is still the same. Also, so when you say risk reward ratio, in a case where you entered yourself at 76.4%, your profit possibility is, this is your reward, right? Look at the risk compared to the reward, right? That's our risk there. And this is our reward. So that's why we say, you see me write about my RR. So risk reward ratio, it's good where you enter at 76 or at 61 as compared to when you enter at 38, all right? Because in this case, in the other case of 38, it's almost 1:1. This will be your risk and this is your reward. You can see the difference, all right? So when you enter at around 38, you can add position at 76, which we call it averaging, right? It gives a good opportunity to end at a good price. And also, in case the market does not move all the way to your take profit, let's say the market moves somewhere up to around, oh, sorry, just what did I do? Okay. Let's say the market moves, you enter your entries, everything is gone, it's fine. Let's say you sold here and then you sell again at a bigger volume. Then the market just moves and at around here, you see it struggling, all right? You can comfortably move your stop loss to around here. You reduce losses. You can even close all the trades. So this helps to reduce the risk of the earlier entry you entered earlier, all right? It's a good way of trying to look for a graceful exit. You see the market is struggling, you're like, these entries may not give me profit, but already this one has covered the loss this one had already incurred, right? So you're able to enter at maybe a few pips profit, or at least at break even. At least you don't lose. This one helps to cover the loss. This one had already entered when it started working against you. The earlier entry, when I sold, I also closed it earlier because I saw at M5, the market formed a double bottom. All right, you can see this. So when I saw that, I just closed my entry. Look at that. Then you look at that. When the market formed this double bottom, I exited because I could see the market might retrace deeper or could be reversing altogether. Some of the things can actually make you don't have to wait for your entry to hit TP because there might not be a possibility of your entry hitting your TP. And there is no need, you've been so much profit for you to give it back and close at a loss, all right? When the market signals you, like it's changing direction, you are better off exiting your entry, all right? Any question? Any question on that before we move on to the next topic? We are together. Great. So we've been focusing on technical analysis. Now we are going to focus on what we call fundamental analysis. Right? That one will not take so much time. Because it's just more of theory, but I will need to show you how to follow on those the fundamentals. Okay. So we are done with this. Great. So remember we say there are two types of analysis, technical analysis and fundamental analysis. But our strategy is built more on the technical analysis, but we cannot ignore fundamental analysis, all right? As I mentioned earlier, like this week we saw last week, the technical analysis for SP500 was showing the market is reversing. But there was most of the companies in US are releasing the earnings, their Q1 earnings, which were more than what was expected. Of course, now that boosts the stock index. It boosts up the Dow, the S&P 500. So it sort of changed again. So even if you've done your analysis, you have to give room to the fundamentals. What are they saying? It's good to understand what is like to affect the market this week. What's like to affect the market maybe in this period of time. Like this week, there were elections in Spain. Also note that will also have an impact on the euro. So I was to send you the list of the countries which use euro. I will still send you, even if not today, I will ensure it's sent before end of the week. Yeah? So you're going to look at the fundamental analysis to know what do you look at? How can you tell what is expected at US, which is like to affect the US dollar? What is expected in Europe, which like to affect the euro, right? So, and you're saying fundamental analysis is based on economic data and geopolitical factors. Traders who trade on fundamental analysis will carry out their analysis based on the data released by a certain economy, which indicates the economic performance of that country. So what happens every week? We have we already have an economic calendar where it tells us what to expect for the 8 major currencies this week. Yeah, so it's good to always peruse through to see in the course of the week which are the key data which is like to affect that particular currency, be it the dollar, be it the pound, the euro, right? Depending on the currencies you trade mostly. So at your own time, just read this. Read this because this most of it is theory. Then there are the key reports. Like for dollar, what affects the dollar? Which key reports affect the dollar? Like the GDP this week, the US was releasing their GDP and it was more than what was expected. Of course, that strengthened the dollar a bit. Yeah. Then we have the retail sales, the consumer price index, the CPI. This is the inflation. This is a key report for most of these major currencies because the central bankers, they use the CPI, the inflation report, to decide whether it's one of the key reports. Of course, they use many reports, but CPI is one of the key reports they use in deciding whether to raise interest rates or to reduce interest rates. Okay, so it's a key report when it's being released. Then you have the personal consumer expenditure. So at your own time, just read what each report entails. This we may not be able to read through, just theory. That's straightforward. Then we have the important economic indicators for the euro, the key reports. GDP always there, employment change, yeah, all of them. Again, CPI has to be there in all of them. Then we have for, sorry, what did we cover there? So USD, euro. We have for GBP, again, consumer price index, unemployment rate. This is just straightforward. At your own time, just read through. We have for JPY, Japanese yen, the key reports. CAD, Canadian dollar. We have the AUD, NZD. So what happens? So I want to show you, so how can you tell what is expected in that report and how the market is likely to react? I want to take you to the economic calendar, which I should have told you earlier to download, but it's fine. You can just do it at just 1 second. Yeah, I have it open. Yes, just 1 second. Let me share my screen to just show you how to read that data, the economic calendar, to know what is scheduled to be released each week. They always release it update it mostly on Fridays for the following week's report. Great, I'm sure you can see it. So this is the economic calendar. We use the Forex fact. Of course, there are many others. So there's the Bloomberg, there's other economic calendars, but we mostly use the Forex Factory. You can download this to your phone or to your laptop. It's always good to have a glance at what are we expecting today for the various countries, okay? You can see like today there was China manufacturing PMI, it was red. So first of all, when you see, this is the date, today is Tuesday, April 30th, the time the report is being released. So you have to ensure you tune it to your local time zone. Otherwise, it will confuse you. Like here, what you're seeing is actually the South African time. All right. So when you download it, you synchronize it with the Kenyan or wherever you are as per the local time zone, so that you're able to get the right report at the right time. So then the currency, it not to tell us which that report is, it's affecting which currency. Then the impact. If it's yellow, it means it's low impact. Red, it's critical. It's likely to cause the currency to move. It's high impact expected. Then we have the orange, medium impact expected. All right. Just when you place the cursor, it can just tell you what, but the color, that's what it means. Yellow is low impact, orange, medium impact, red, high impact. All right. Then when you open the report, like I can check for tomorrow, you only have the previous reading and the forecast. The researchers will collect data to see what are we expecting, what is forecasted as this week's reading, or rather this month's reading, or the current reading for what are we expecting, what has been forecasted from the research carried out. All right. So when you check, this is what will appear before the time comes. When the time comes and the report is released, now they fill the actual column. Right, like you can see today, it's all of it is already filled. So if it is worse than what was expected, they put it here in red. All right. So when it's red, it means it's likely to affect that currency negatively. If it is just in the range of what was expected, like you can see the private sector credit for AUD, we were expecting 0.3. It came 0.3. So no change. It's the same. So they're actually just the same color. All right. But if what was expecting, it's better than what was forecasted, then it will be in green. So this affects the currency in a positive direction, right? So that's what it means. Red means it was worse than was expected. Green, better than what was expected. And then now the same color means same as expected. So no move expected in there, no major moves expected in the currency. Okay, so you can always check, like especially when the CPI is being released. I just like being on to check, like on Monday. So what has been forecasted? Because if great, there's something here we need to check for tomorrow. The Federal Reserve Bank of America, we call it in short just the Fed, they are supposed to make the rate decision. This is really very key report. And anytime any of the major central banks are making decisions on their rates, that is likely to cause the markets to move. You see, we are expecting the same thing. But just in case they surprise the market, which is rare, it cannot happen. Maybe tomorrow they just come and cut the rates. Then you expect major sparks, major moves in the dollar, all right? So one of the key reports, check when that bank is expected to change to make a decision on the interest rates. And if there is a change expected, then you expect the market to react. But what happens? Because by the beginning of the week, we'll get what is forecasted. Let's say for the federal funds rate, we expected something higher than the previous, something like 3%. The moment they fill this column of forecast, all right, mostly they fill it on Fridays or thereabout, just some days before it is released. If it is higher, and we said if the interest rates are higher, they attract investors. Many people want to buy that currency. So the moment they feel that the column for forecasted and it is higher, the market starts pricing in, right? So you will see the dollar rising even though the report is not yet released. So we call it pricing in to make it to reach what is expected, all right? So it's actually better when you join the market at the time of pricing in, because many times you realize if we expect them to raise, and higher interest rates attract more investors. So me and you may just sit down and wait for them to raise, then we buy. No, actually what happens, the moment they put for us what is forecasted, the major traders, they start pricing in. They start the dollar starts appreciating. So the moment the report is released, you may actually see the dollar coming down. Then you ask yourself, I thought it was supposed to strengthen, because the market has already priced in the expectation, all right? But if the market has priced in the expectation, but whatever is released, the actual is lower than what was expected, then the market starts rewinding, all right? Or the investors start releasing whatever they were holding, whatever they had priced in. So you expect sometimes major moves during the time of when the rates are being done, or even the CPI reports, all right? But when they are giving the statement, like tomorrow at 9 p.m. Kenyan time, during the FOMC statement, because remember, these are people reading a document. The traders are not reading the document. As they interpret it differently, you see the dollar spiking up and down, up and down. What I do personally during the speeches of those people or the central bankers, or when the reports are being released, like a written report, written statements, I would rather stay away, because it takes until the market calms down. Because what happens, some investors, we read a line, they buy. Others, the second line, they sell. So you find that the currency has no direction. So especially when there are such statements being released or reports, you better off stay away from the market until it calms down. It decides which direction it is now taking. Otherwise, you'll be hit with the sparks. You buy your hit. You see the market going down, you sell, against that reverse, then it knocks you out. Right? I've been there, so I'm telling you from experience. So I prefer to stay out. But it's just a rate being released, then you can consider. Or just the normal reading reports, like the CPI reports, the GDP, those ones you can be able to enter. Tomorrow, many banks are closed. Of course, it's a public holiday, so there'll be no much activity. Yeah. I want to show you report for next week. Yeah. Next week starts from Monday. Yeah. As you can see, report for next week, there's nothing forecasted. They usually fill this column mostly on Fridays or Monday early in the morning. All right. So when there is a key report you're expecting next week, like next week, any report we think should be released, cash rate for AUD. Have been reading some reports. AUD might cut down their rates, right? They might lower than 1.5%. So if by Friday they put maybe 1.0, everybody will start selling the AUD. No one wants to hold a currency which has a lower interest rate. All right. So you find already now they start pricing in the expectation even before the report is released. Right. So if you really want to also be the kind of a fundamental trader, check the reports maybe on Friday evening or Monday early in the morning. See what has been forecasted, especially on the major reports, the rate decisions, the CPI. Just check through the ones in red, the ones just so they are red, but they really make a lot of sense, like the cash rates and all that. Then once the forecast has been filled and it is different from the previous, a change is expected, then you can join the bigger investors. You start pricing in the expectation, all right? So that's it. Sometimes you can. There's a time last year the pound was really reacting to the CPI. By then, the inflation rate was around 2.9%, which was way above the expectation. The Bank of England, they had not raised the interest rates for quite some time. So when the bank has said for long, there's also that there's a lot of reaction by the market, all right? So that time of course, the pound was moving a lot. And also, you look at which currency to pair with. Like if a bank, let's say the US, the Federal Reserve Bank of US, they are planning to raise interest rates. If they are planning to raise interest rates, many times people will pair it with the JPY, Japanese yen, because their interest rates are zero, right? So where interest rates are expected to change, you're better off pairing it with a currency with the lower interest rates, right? So many times where the interest rates are supposed to be affected, many investors will pair that currency with the other currency with the lower interest rates or extremely higher interest rates. But many times you never go wrong with pairing that currency with Japanese yen because their rates have been 0, 0, 0, all right? I don't know the zero is actually zero, okay? So when you notice America, they are planning to raise their interest rates, then you can buy USD JPY, all right? So if you expect to go down, you also do the same. You sell the USD JPY, all right? So that's how you select the paper to know it is likely to move more when those news are released. That's basically what you're saying, okay? So by Friday, you can just download in your laptop or on your phone, Forex Factory Calendar. Then then ensure you synchronize the time with your local time so that you can be able to see the report at the right time as per your country time zone. So also, you also see a lot of news here. They release also news on time. You can always tell what is happening. Like Brexit news, they're always appearing here. You can tell what to expect. You can also comment. Anytime you refresh, you can see what has been released, which is sometimes actually you see the currencies running and you're like, what is chasing you to come and see there's some hot news which has been released. Then you join the market, you enjoy the party with the rest of the traders, right? Like the dollar. I remember the times of when this Kim of North Korea, the time used to test the missiles, especially on Fridays. You could just be watching the gold. Then all of a sudden start just running up and you're like, what has happened? Coming to check, yes, the news has been released that he's planning to test missiles over the weekend. Of course, when there are such kind of risks, people will run. When you know, like there's an expected war or fights or struggles between the bigger countries, or rather the major currencies, the country for the major currencies, many investors run to what we call safe havens. They will buy gold or the Japanese yen. They prefer to hold Japanese yen because it has no interest rate, so there is nothing they pay for it. So when you hear there are issues, they expect maybe like the time they were testing the missiles. So every Friday you could see everybody running to buy gold, so gold could shoot. All right, the same case that's going to Japanese yen. So the gold and Japanese yen are the safe havens where they run in case of war or anything is likely to cause some drift between the two countries. So when they started talking, I remember the gold, they started weekend, the gold just gapped downwards, started coming down, and because there was some peace, the risks were reduced because now the two presidents are talking and they are trying to resolve the pending issues. So that is what happened. Even when we had the trade war between China and America, that's the war of words, going to raise the tariffs, blah, 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 those kind of discussion. The traders try to run, to risk, to save havens, the low risk instruments. So in those moments, you also find the gold going up and Japanese yen going up. When calm returns, then people start rewinding their positions or closing or maybe shorting their position or selling whatever they bought earlier. Then the gold starts going down. So it's good to also get to know what is happening. Once in a while, just come and check what news are being released. Are they like to affect any currency, and which one which is like to be affected? Which one can I buy or sell to benefit from the news being released? All right, so you can always check on the news around here. Great. Any question? If there is no question, just move on to the next topic, which will be our last one for today. Today is also that is also another theory topic, so we will also not take much. Because when there is theory, you can just take your time and read, then you can ask any question, even in the WhatsApp group. So our next topic is currency commodity correlation. It's also very short, it's all theory. So we said in this topic, look at which commodities affect which currencies, all right? And by commodities here, we mostly refer to gold and oil, okay? So we see if gold is increasing in value, which is the best currency to go for, which is correlated with gold, all right? Same case to oil, all right? So you're going to see some of them and then see how do you trade such kind of correlations? How can you benefit from such correlations? So currency and commodity correlations. So it is widely known that economic growth and exports are directly related to a country's domestic industry. So it is natural for some currencies to be heavily correlated with commodity prices, right? So even this being theory, I don't think we need to read through. I will just explain to you, then at your own time, you just go and read and try to ask any question. Or you also observe what happens when oil goes up. Like oil and Canadian dollar, they are highly correlated. Because Canada is a huge exporter of oil, okay? So when oil prices are going up, a drop in oil prices is every oil producer's nightmare, while oil consumers enjoy the benefits of greater purchasing power. So there are a number of reasons to explain the fall in oil prices, including a stronger dollar. But that is a little bit minimal. So as a net oil exporter, Canada is severely hurt by declines in oil, while Japan, a major net oil importer, tends to benefit, right? So when the prices for oil is going up, then you expect the CAD to strengthen. But because the prices are going up, and Japan, they are net importers of oil, it will be affected negatively. So in that moment, you can actually pair, if the oil price is going up, you can pair CAD and JPY, right? Because you expect them to be affected in an opposite direction, okay? That is when there are major moves in oil prices and or the quantities of oil. So CAD and oil, they are positively correlated. Please at your own time, just read through. We don't need to read everything, I think. Japanese, we mentioned to them because they don't have their own natural resources. They import oil. So if oil prices go up, Japanese yen, it's affected. So it tends to weaken because they have to spend more to import oil. So that is where we have the correlation for those. Then we have gold. Trading the Australian dollar is just like trading gold in many ways. Australia is the world's third largest producer of gold, and the Australian dollar had an 84% positive correlation with the precious metal between that year and that year. So this means that when gold prices rise, the Australian dollar appreciates as well. Okay, so when gold is going up and maybe you don't want to buy gold, at the same time you expect the AUD to go up, the Australian dollar. So you can also buy the currency which is correlated with gold. Okay, so if you want to trade commodity currencies, the greatest way to use commodity prices in your trading is to always keep one eye on movements in the oil or gold market, and the other on the currency market to see how quickly it responds. And that is very true. Even the time gold was going up, also AUD was also going up. That's how they are correlated. I think there's something. There's also some small correlation. I don't know how come those notes are not here between gold and New Zealand dollar. Because New Zealand, they are the only country who keep their reserves in gold. So anytime also gold goes up, their currency also goes up. I don't know how comes that clip is not here. I'm not sure how. But there's a small correlation between the two. Just because the New Zealand, they keep some 25% of their currency is kept, it's reserved in gold. So when gold goes up, also their currency goes up because of that reserve. But these are the major correlations. That is gold and Australian dollar and oil and Canadian dollar. All right. Any question? And I feel we've covered so much today, so I really don't want to go deeper into what we should be able to add now. I have to just give you time to practice. Of course, also prepare for the holiday tomorrow to relax. Any question? I don't introduce anything new today. Next topic, you're going to look at the key indicators, which are also used in the market, although we focus more on price action, because with price action, you're always ahead of the market. It's also good for you to have an understanding of how some of these indicators work, so that even when you come to some analysis, you have an understanding of what indicator they are talking about and how they work. Maybe even you can just feel like, let me try the indicators. It's good to have the full knowledge, even if you decide to still focus on price action, to understand how the key or the commonly used indicators, how they are used. Then from there, we'll go to trading psychology and risk management. That is now what you are remaining for there before class ends. You should be able to cover that on Thursday and Friday. Any question? Great. So if there is no another question, please continue practicing. Look for the ABCD pattern. Draw the Fibonacci's. Try to look for the 1:1 harmonic ratios. Yeah, draw and see if the market respects that. Then now we can discuss further. I will still leave my 2 entries pending. Actually, they will be, but because I'm just looking at the chart right now, and there's a candle which has closed above 76.5. All right, but I will still leave it running. I will not close them. No. When I look at the bigger time frame, the M15 still shows no candle closed. And that is what we drew our charts using. It's fine. We'll just leave it running. Let's revisit on Thursday and see what happens. Great. So if there is no other question, we'll end the class there. I wish you a nice evening and enjoy your Labor Day. Have a good time with your families. Bye and God.